Bang. So now we're moving on to the risk subject. So credit risk assessment, one of the core areas to me within credit management. And I'm going to be going through the content and stuff with you. And before I start, what I would like to do is to introduce you to Angelina. And Angelina will be your tutor for this subject. And so Angelina will be sending you the notes according to the schedule, and you will be sending your short tests and assignments back to Angelina for correction. And if you have any questions, queries, or whatever, Angelina is the point of contact. So Angelina, I'll hand it over to you and let you do the introductions, and we'll take it from there.
Yeah. Hi, how are you, everybody? Hope you're excited to get started with the credit risk module. As Declan mentioned, I'm Angelina. I'm going to be your tutor. I'm currently working in the Public Service Credit Union. I've been there for nearly 20 years. Actively involved in our credit control function for about 10. I completed the diploma back in 2016, and I have to say it was challenging, but I absolutely loved it. I definitely felt it gave me a newfound confidence, not only in my approach to credit control, but my overall approach to work and other things. I'm also tutoring for the last 4 years with Declan.
Yeah.
And again, time is flying. I can't believe it. And like, it's so rewarding. It is a challenge, but there's nothing better than seeing students like yourselves getting a better understanding of the credit risk module, having your light bulb moments, being able to understand adjustments, profit and loss, all that kind of thing. So I will say though, guys, like, it is a challenging module, but get off to a good start. Be patient with yourselves, and please utilize us as tutors for support. There's nothing worse than coming Sunday evening, you have your short test due, your assignment due, you're pulling your hair out going, God, how am I going to approach this? Like, please reach out. We're there to help you, okay? Our aim really for the module is to get an overall understanding, Declan, really, of the material.
Yeah.
We're not looking for you to be experts. It's just, as I say, having a better understanding of how profit and loss, the balance sheet works, your ratios, all that kind of thing. So it's, you'll get through it and put a little bit of work in, submit your tests, your assignments. Don't have the fear of not submitting, because if you don't submit, we won't know what you don't understand or maybe where you might be going wrong. So please do reach out. So I'd say I'm really looking forward to working with you. Best of luck, and I'll be in contact with you in the coming weeks to get rocking. Okay.
That's brilliant. Okay, Angelina, thanks a million, and appreciate all your work and efforts as well. And I suppose just to put the whole credit risk topic into perspective for you, to me, this is one of the core and one of the very important issues. Sorry, I just see Caroline has joined as well. So that worked. So yeah, it's very important. So why is it very important? Because to me, credit management, yes, it's about collections and collecting money. That's part of what we do. At the front end, though, making decisions, making credit decisions, deciding who we're going to do business with, what extent. So the things I was talking about earlier in terms of setting lines of credit and all this good stuff, it's an art and it's a science. And part of what you need to know as a credit person is how to read a set of accounts. Now, look, we know you're not accountants, and we know you'd never want to be accountants, God forbid. So while we do report to finance, in a lot of cases, we are not accountants, and I'm very proud of the fact, and I never want to be an accountant. You do know you're making progress from a work perspective when the salespeople call you an accountant and the accountant call you a bloody salesperson. That's when you know you're doing your job right. Is that okay? Because you're not sitting in either camp. So on that basis, this module was born. So it is accounting based, and particularly the first two modules are fairly accounting based, because we want you to understand accounts. We look at things from a credit control perspective, and you've probably learnt already by reporting to finance that accountants do things exactly the opposite way that we do. All right. Give an accountant and a credit controller 20 pieces of paper to file them in order in a lever arch file, and they will do it the opposite way around, because that's just the way our brains think. All right. And part of that is because accountants are dealing with the past. The accountants are reporting on what has happened. They are looking at history and creating accounts. Credit control, by our nature, we're looking forward, because I don't care what you did 2 years ago. I care, can you pay me next month? So we have a totally different focus on the business, and it's right. And there's a place for both. By understanding accounts and accounting, by understanding a trading profit and loss and balance sheet, by being able to read it, I'm hoping that at some stage in your career, somebody will drop a set of accounts on your desk and say, are they good for 10 grand? And now the work begins. And the tools that you will learn from this course will give you the confidence, ability to be able to read them, to understand them, and do all that kind of stuff. Is that okay? So I'm going to apologize in advance that the first two modules are accounting based. I'm not going to apologize. You need to know this stuff. You need to know this stuff. And even when I'm listening to the business news or whatever, and I hear these guys saying stuff, and I just know, look, they're reading words. They haven't a clue. They don't even know what this is all about themselves. So it's a bit of financial literacy we want to give you. And that's what it's all about. So and what we have done, and what we pride ourselves in doing, is that over the 4 modules, we have turned accounting into English. All right. So there are notes. That's really what we want to do. And if you're sitting there with this big mental block in the corner of your head going, oh, I hated accounting when I was in school, I hate it, stop, switch that off right now, because mental blocks is what will cause all your difficulties. So switch it off right now. This is English. This is simple. This is whatever. And Angelina said the words, which is great. We want to give you an overview. You know, that's really the whole point of what we're doing. We want to give you an overview of where transactions start and finish within the business, because accounting can seem like a daunting prospect. And when you break it down, you know, all that we're doing is, and all accountants are doing, is they are recording where the money came from and where the money goes to. That's all that accounting is. So, you know, in terms of having this high notion of what a set of accounts is all about, it's literally recording where the money came from and where it went to. So that is that. So what we'll do is the history and background, and you're not expected to remember all this stuff. You're not expected to know all the words in detail. We want a lot of this to wash over you as well, and then also to put your minds at rest as well. When it comes to the exam in January, you will be sitting at home with the notes on the desk in front of you, so you don't have to remember everything. Do you get that? So that's,
there's no surprises, Declan.
Sorry?
There's no surprises, you know, we're not trying to trick people. No.
And we're not here to trick you. We are here to bring you to a certain standard, and that's really what we want to do. So in terms of module 1, yes, we go into the reasons for keeping records, the concepts, the rules and regulations, and, you know, I'm going to explain it all in simple terms. And to be honest with you, you don't even have to know the difference between a debit and a credit to get through. We will explain it to you so you have an understanding. That always confused me, you know. So and I'm coming at this from an accounting perspective. The accounting equation and starting up a business. So what we do in the notes is we kind of build up a scenario where somebody has set up a business and we track all the transactions in the business. So from putting a few bob into it to getting a bit of equipment to buying stuff, selling stuff and doing all that sort of stuff. And what we do is then we track all the transactions and the accounting records that are required. So while you're looking at a debtor's ledger, you know, the accountants are looking at their nominal ledger or trial balance or whatever. And the accounting terminology as well, just because of the language that's involved in accounting, we'll go through and explain to you what everything means in pure English. And again, this is for your own records, because we do report to finance, so we need to be able to talk in the same language as those guys. So when they're talking about, you know, accruals and prepayments and EBITDAs and all these kind of good stuff, you know, it's kind of helpful if we know A, what they are, or B, we know where they are in the notes, so we can go and find them. So the accounting equation then is your first introduction to breaking down so where the money comes from and then where it goes to. So there's different areas that we can put money into in a business, into capital, into assets, in terms of doing the business. So in a business, an asset is something that you own and a liability is something that you owe. So who do you owe money to? What assets, what do you own? What can you put your hands on? Income, which is from sales and from the activities of the business. Expenses in terms of the running expenses within the business. Liabilities are people you owe. We will look at the double entry bookkeeping to show you very simply that, like, if you buy a pen for a fiver, you know, the fiver comes out of the bank and it goes to the shop for the pen. Are you with me? And that's all accounting is. You know, yes, we're creating a creditor if they're giving us credit for the pen. So we're taking the money out of the bank and we're putting it in. And maybe this is it's probably an expense more than an asset. So, you know, so we're just literally recording all the transactions within the business. So we'll go through all the different transactions within the business, showing, so from a double-sided perspective, where the money came from and where it went. Then in terms of posting it to the nominal ledger, and you have exercises on that. And then from the nominal ledger, then we extract what's called a trial balance. So that's where we list everything we owe. So just to put it in very simple terms, your profit and loss account, and sometimes it used to be called a trading profit and loss account, that records everything that you buy and everything that you sell. So trading is buying and selling. That's what trading is. So we buy stuff and we sell it, hopefully at a higher price. So if we buy something for 100 quid, sell it for 150, we have made a gross profit of 50 quid on that. So that is that. And out of that 50 quid, then we have to pay all our expenses. And then whatever's left after we paid our expenses, that's the profit that we have from the activities that we've engaged with. So your profit and loss account is a summary of transactions within a defined period of time, which is usually a 12-month period. And for the purpose of all the exercises we do, the year ends on the 31st of December, although we all know that's movable and can change. So it's everything that we bought and everything that we sold within that period, and then to see, did I make a profit in that period, or did the business make a profit? That's what that sheet of paper tells you. The balance sheet then, well, no, we'll move on to that. So in module 1, we just look at the trial balance, the preparation of a profit and loss account. And I put there in brackets beside it income statement, because the accounting bodies are now rebranding just to confuse everybody, to make themselves feel important. So what used to be called a profit and loss account in old money, in the future is now going to be known as an income statement. They're exactly the same thing. No point in getting upset about it. So that's how do we prepare a profit and loss account. We'll have a look at that. Adjustments. Why would we adjust a profit and loss account? And a lot of the accountants are doing adjustments and all this kind of stuff. Well, they're doing adjustments to ensure the integrity of the accounts within the set period of time. That's all. So, for example, if they pay 12 grand to their insurance company for insurance on the 1st of December, so they're paying a year's insurance on the 1st of December for 12 grand. So the 12 grand comes out of the bank this year. Yeah. Hold on though, only 1,000 of that relates to this year and 11,000 relates to next year because my insurance premium is up on the 1st of December. So to take that 12 grand and call it an expense for this year would be wrong because it doesn't relate to this year. So what we have to do, we have to adjust the accounts and say, well, look, yes, we paid 12 grand insurance on the 1st of December. 1,000 relates to this year, so it's an expense for this year. The 11,000 relates to next year, so that's a prepayment into next year. So we get our profit for the period right. And the reason we have to get our profit right is because we pay tax on our profits. So the tax man wouldn't let you get away with minimizing your profits. So if you paid all next year's expenses up front and then deduct them as an expense, reduce your profits, and then you pay tax on profits. So just to be aware of the 360 view of them as well. So that is your trial balance. And then we will get you to the income statement or profit and loss account. And the three key things within the profit and loss account is your margin, which is your profit margin, your markup, and your gross profit and your net profit. And sometimes your net profit it's called net profit, it's called earnings, it's called EBITDA. There's lots of different words. It all means the same thing. It's what you get to put in your pocket after you've finished and paying all your bills. All right. So now we've gone from what we bought, what we sold, all our expenses, how much money we made. That's effectively what a P&L account is. Module 2, we do a bit more preparing final accounts and then explain the profit. NBPIT is net profit before interest and tax. You probably heard EBIT, which is earnings before interest and tax, same thing. And then EBITDA, and they're adding more and more stuff onto it as you go. It's literally just profit. So we'll explain all the different types of profit and the implications to the business of that. Then we move on to page 2 within the set of accounts, which is the balance sheet. And the balance sheet is simply a list of everything you own and everything you owe at a moment in time. That's all it is. It's a list, and there's two things in it. There are your assets, which are the things that you own, and the liabilities, which are the things that you owe. So that's all there is. And if you're looking at fixed assets are the big things that we need to run the business, our premises, our trucks, our machinery, our plant, they're the things in the business. There are fixed assets, or they're now called non-current assets. That's the first thing that we account for. Then we have our current assets, which are the things that are running through the business the whole time. So that's what that's all about. I'm just looking here. Did I hit record? I just had this horrible thought. Bear with me. I'll just stop sharing and see.
Yeah, you did.
Yes, definitely. I did. Yeah. No, I just had a momentary lapse there. Guilt swept over me going, did I hit record? I did. Yeah, I can relax now again. Okay. So your balance sheet is a list of everything that you own and everything you owe at a moment in time. Okay, so if your balance sheet is on the 31st of December, that is the position as of the 31st of December. So that's how much you owned and that's how much you owed at that point in time. So, and that's why, again, we have to make adjustments to make sure that we're presenting a correct figure for that moment. And in terms of the balance sheet, there are rules about how we value stuff and all that good stuff. And we'll certainly go into all of that as well. So we'll look at and again, the balance sheet in the statement of financial position is new terminology for it. You will probably know it as a balance sheet. In future accounts, it will be a statement of financial position, and we want you to be up to date with the latest information as well. So preparation of things. And with those two documents, so we look at current assets, our stock, our debtors, our bank, provisions and reconciliation. So what's the whole concept behind provisions and what are we doing there? In the balance sheet, working capital. And let me tell you right here, right now, that one of the great dividers between this course and accountants and everything else, and let me also tell you something before we start. If you are relying on your accountants for advice and help through this module, I need to warn you up front that a lot of the information that you will get, your accountants will go, what? Is that all right? And I'll tell you why. Because in some cases, I will give you the exact opposite advice that your accountant will. For example, accountants will tell you that the two most important numbers on a trading profit and loss and balance sheet is the net profit, which is the money the company made in the year, and the net worth, which is how much the business is worth. So the difference between what you own and what you owe is how much the business is worth. And all the markets, all the stockbrokers, everybody else is looking at profit and they are looking at net worth. Okay. From a credit control perspective, what we need to look at is this area here called working capital, because your balance sheet might be worth, 2 million. And in that 2 million could be the company Ferrari for the managing director, which is worth 1.7. So even though the company has assets and it looks like it's owed a lot of money, when I'm saying I mean you, what you're concerned about is, can they afford to pay their bills? That's what we're looking at. So we're not looking at the business from the business owner's perspective. We're looking at it from a credit management perspective. Do you get that? So an accountant will tell you the higher their creditors are, the better. And they will say that because, that means the company gets to hold on to the money and they love the higher the creditors because you get to keep the money in your bank account. I am a credit controller. I love customers who pay their bills. Okay, so to me, the lower their creditors figure is, the better. I like it because these are people who pay their bills. So we are going to be looking at it from an accounting perspective. We're going to be looking at it through credit eyes as well. And to me, this working capital figure, the difference between their current assets and their current liabilities, that shows their ability to pay their bills. And that's what I'm concerned with. All right. So that is your and then once you finish module 1 and module 2, which is the trading account, and you'll be very familiar with that and you'll be able to prepare one given data and all that sort of stuff. Then on module 2, the balance sheet and all the adjustments and why you'd adjust it and all that kind of good stuff as well. And then as your first assignment on module 1 and module 2, we are going to give you a pile of data in terms of, these are all the numbers that we extracted for the company over the years. And now it's up to you to prepare a trading profit and loss and balance sheet for them. All right. And there is a formula. And please, guys, overthinking it is the worst thing you can do. You just follow the formula. And in a trading profit and loss account, it starts with sales, then you have your opening stock, you add your opening stock to your purchases to see how much could you have sold in the year. You subtract your closing stock because that's stuff you didn't sell in the year. And then you come to a gross profit. Then you list all your expenses, then you get to your net profit. So there is a formula for it. And same in the balance sheet. There's your fixed assets, there's your current assets, there's your current liabilities, your long-term liabilities. And then financed by is where the money came from. So be it capital, shares, investments, profit, wherever the money came from. So it's very simple. And we just need the penny to drop, as Angelina said. And once you get that, and then you get your first assignment, which is to prepare a set of accounts. And just remember in all of this, guys, as well, all you need is 40% to pass. There are people who have this perfection complexes and want everything to be, they want to get 100% in every exam. That's not what's expected of you. And certainly with the assignment, once you submit that, and Angelina corrected, you'll get your feedback on assignment, say, well, look, you missed this bit and that wasn't there and you should have done this. And you will get marks for everything you do. We will not deduct marks for everything you don't do. Is that okay? So if you get anything right, you'll get a mark for it. Yeah. So that is module 1 and module 2. So once you get to that stage, we're happy that you're happy. And the whole thing about a trading profit and loss on a balance sheet is that whether it's a sole trader, whether it's a small company, or whether it's a multinational or a PLC, the format for the accounts is exactly the same. Now, maybe, Kerry Foods balance sheet might run to 15 pages because they have lots of breakdown of details and stuff. The overall format is exactly the same. And that's something that you need to know. So once we know that and we can read it and we know where to go looking for stuff, that's where it all gets interesting. So then in terms of module 3, to me, this is where the rubber hits the road. There's a bit of a diversion at the start in terms of the cash operating cycle. So you understand managing cash flow and managing, because that's what you do, and forecasting cash. So this is how much money I have in the bank. What will I have in the bank at the end of November? And believe it or not, it's not guesswork, because I know how much I have in the bank. I know how much I'm owed from my customers. I know how much I'm going to sell in the next 2 months. I know how my customers pay me. I know what my wages are. I know what my ESB, I know what my... So we can kind of make a very good stab at it in terms of doing cash flow forecasts to say, well, look, this is where we are. And based on everything else, we can roll forward, either week by week by week or month by month by month to work out, on the basis of how things are going at the moment, how are things going to look in the future. And again, this is all about avoiding surprises. So there's formulas, and there's formulas for all this kind of stuff as well, cash flow forecasts and statements. And you might be involved in it and not know you're involved in it. Your accountant might come down and say, how much money are we due in this month, or how much money is coming in. So and what they're doing. So if you have an understanding of the whole cash flow, and just without even an understanding, always give a figure that you're confident you're going to hit. Make sure people aren't pointing fingers that you left them short. So if I think I'm going to get 100 grand between now and the end of the month, I will tell my accountant I will get 80. And then if I get 85, I'm the great guy. So always under promise and over deliver. That's the secret of good work. So that is that. And then we get to the bit that I love. And the bit that I love is the interpretation of financial statements. So now I have a profit and loss and a balance sheet in front of me. And what I'm interested in, and this is important, I'm interested not so much in the numbers. I'm interested in the story those numbers are telling me. Is that okay? So when we're getting into analysis and interpretation, we're going to start looking at different numbers within the profit and loss and balance sheet in order to make sense of it. So, and I know when you hear ratios and you go, oh, Jenny, we're into formulas and stuff. No, it's very, very simple. And you will have a list of the ratios. And if you went through accounting manuals, there's probably 1,000 different ratios in terms of monitoring a business. In my life, and just talking about in my life, sorry, I'm conscious of this too. I didn't properly introduce myself because I know who I am right at the very start. So it might be no harm maybe at this stage, just before I go any further. I'm one of these sad lifelong credit professionals, okay? I started working day one in a credit control office, and apart from 3 years on the dark side where I went to accounts payable and then came running back into credit control, I've spent my whole life in credit control, working as credit controller, credit managers, managing teams, multinational companies. And then in 2002, I set up Irish Credit Management Training because I wanted to improve the standard of credit management and understanding, and just to get recognition for credit people, because I just saw it as one of these functions that's vital to the survival of the business, and one that people never take seriously or seriously enough. So as part of my role as a credit manager, all these ratios and performance indicators, I invented a lot of these over the years, and then stuff that I was doing 20 years ago, is only starting to come into the mainstream now. So I'm not one of these academics who read a book and decided to tell you about it. I've been there, done that, lived it, and even in credit management, where we're talking about financial reviews, like I sat across desks from guys and did it. And in terms of the ratios that we're sharing with you here in the course, these are the 12 ratios that have stood to me right throughout my whole career. And these 12 ratios will give you all the information that you need, right? We can analyze it to death. Look, at the end of the day, there is only 3 things that I care about in a business. Number 1 is their ability to pay. That's number 1. Can you pay me? And that in accounting terms is called liquidity. And I have a number of sums that you can do to work out the liquidity of the business, their ability to pay. Is that okay? So that is that. The second thing I'm concerned about is profitability. So I said it's not the most important thing. It's kind of important. So if a business makes a profit, if a business is profitable year on year on year on year on year, chances are that business will stay going as long as they're profitable. If they're loss making year after year after year after year, there's going to come a point where they fall off the cliff. They just can't keep sustaining a loss making business in the long term. So, and if it's up and down, well, then I'm going to have to see, well, hold on. And look, 2021 world in lockdown, yeah, everybody's going to make a loss. Now, the D&Bs and the scoring models go off the Richter scale on that. I'm hoping that with the intelligence that you gain from this course, you'll be able to do your own sums and your own analysis of the figures and come up with something reasonably clever. Is that all right? And what I love about this is in terms of the ratio. So I take different numbers. So for example, what do I do? Rather than looking at the profit and loss and balance sheets separately, what I'll do is I go, okay, look there in the profit and loss account, the purchases figure. So they bought 100 grand's worth of stuff last year. Yeah. And now look over here in the balance sheet, the creditors figure in the balance sheet is 50 grand. All right. So, and that's just a matter of fact. What that's telling me is, hold on, guys, if they bought 100 grand's worth of stuff in the whole year and they still owe their creditors 50 grand, they're taking 6 months to pay. Yeah. So by doing your little investigative work, I can see how quickly they're paying their suppliers, how quickly they're getting paid from their customers. That's your DSOs and all that kind of stuff. How much, what's the difference between what they owe and what they owe in the short term? So in terms of their ability to pay the bills, that's what I'm looking at in terms of the trends. So, if you say to me, Dec, this company has a DSO of 54, is it good? I don't know. I told you, I'm only over 20 years at this. I haven't a clue. Now, 54 itself, not sure. If it was 60 last year and 70 the year before, that's good. So it was 70, then was 60, now it's 54. Yeah, these guys are heading in the right direction. They're collecting their money quicker. That has to be a good thing. If it was 32 years ago, 40 last year and 54 this year, these guys are getting worse. It's taking them longer to get their money. They obviously have a credit controller who's asleep at the wheel, and they will get them into trouble because there'll come a point where they won't be able to pay their bills. So in terms of the 54, is that good? I don't know. If it was 30, 40, 54, 54 is bad. If it's 70, 60, 54, the 54 is good. Can you see where I'm coming from at this? So rather than looking just at the numbers and the sums, we're looking at the trends and are they getting better? Are they getting worse? Because there's only two directions for a business. It's either going up or it's going down. It's either, and if it's going up, it'll sustain. If it's going down, there'll come a point where it just falls off the cliff and dies. And with a lot of these analysis and scoring systems and that, we can actually predict insolvency by working out how long they have to live. Yeah. And it's not as pie in the sky, and it's not that complicated. So by looking at ratios and KPIs for a business, so are they solvent? Can they pay their bills? Are they profitable? Are they making money? And then in terms of management efficiency, so how well run is the business? So are they collecting their money? Are they paying their bills? Are they managing their stocks? You know, so I need to look at all these areas. And if those three boxes tick, then I've nothing to worry about from a credit perspective. All right. So they're the three things that I'm looking at. And that's what we cover in module 3. And then module 4, then I'm going to introduce you to scoring models. So how you can take this information and build complex scoring models. And we've done them for you. So it's just literally a matter of dropping the numbers into a grid and coming up with a score. What I want you to be able to do is to understand. So coming up with a number of 42, there's a score of 42. What on earth does that mean? You know, so I want you to understand behind the numbers. So it's not just about doing sums, although there will be some sums to be done. You have calculators and spreadsheets to do that for you, which is fine. And also this concept of Z scores. So there is Z scores are predictive models, and they're simple formulas, and you just literally drop the number. If it says stock, yeah, you take that number and put it in there. Creditors, put it in there. So you just drop the numbers into the formula, do the sums, and come up with a number, and that number will tell you a story. And I love the whole comparative analysis, and this is something that I invented many years ago, to be able to compare three companies or 5 companies in a single industry to see which is the best and which is the worst. So really clever stuff. And you don't need any D&Bs, credit safes, or any of that sort of stuff. You can work off the raw data and do your own sums on all of this. And then in terms of risk management, so we're classifying risk. So we're able to take our customers and categorize them into low risk or medium risk or high risk, and establishing norms and best practices and all that kind of stuff. And we can do that through the formulas and the analysis and all that kind of stuff. Then obviously, you know, we want to finish the course on a negative note, because that's the kind of people we are. We are still realistic and all that sort of stuff. So again, in terms of bad debts and doubtful debts, so how do we treat it from a financial perspective? How can we measure the cost of it? So look, we know not everybody's going to pay us. We know there's going to be bad debts, and all the good stuff you learn here, you know, you're of course you're going to have write-offs. That's life. And I tell you, if you didn't have write-offs, I'd be more upset with you. If you said to me, Jack, I haven't written off money in the last 10 years, I would say, well, then your credit policy is far too strict, and you're missing opportunities out there in the marketplace, because you have to have write-offs. You know, you have to. And it's about balancing your risk and reward. That's what the whole, to me, the business is about. So we maximize the sales, we manage our bad debts. And what's at the back of my mind, and hopefully when you finished this course, what's at the back of your mind is that what matters is how much profit your company makes. So I want to maximize the profits for the company who's paying my wages. And that's where I become a valuable resource to them. I'm not just this guy on the phone, the bloody debt collector or the anti-sales squad or the sales prevention team or whatever. You know, I am adding value to the business by increasing our profitability, by making decisions, and that will add to the sales and to the profit of the business. And yeah, I'm going to get an odd one wrong, boo-hoo, right? As long as the additional profit that we make supersedes the little amount that I lose, the overall profitability of the business stands. And that's what I'm concerned with. So we will look at bad debts and how to manage it, and particularly provisions as well. You know, I always describe provisions. My bad debt provision was the padding on my posterior. So would I get a kick if there was a bad debt? Yes. The more padding I had, the less it would hurt. So that's your and I would manage the provisions as actively as I would manage the ledger, to be honest with you, because that's what they see upstairs and that's what matters. And then in terms of business failures, so again, with the knowledge that you have with the numbers and the figures and the scores and all that kind of stuff, just looking at the different warning signs, there are things that you can see, and once they've been pointed out to you, hopefully they're obvious. You go, oh, yeah, I've seen that. And just by understanding that, you just have an early warning system. Because what I want to make sure that you will do, are you going to have bad debts? Of course you are. Are people going to catch you? Yes, they are. But a business goes up and a business goes down. Our exposure is high and our exposure is low. And what we want to be able to do is see the writing on the wall in advance and make sure that when the company does go, that we're at the lower end of the exposure rather than at the high end, get caught for a huge order in the last month or something of that nature. Yeah. So that is business failure. And when you're finished module 4, your second assignment is going to be on financial analysis. So you'll be given 5 companies, or maybe 5 years. So 5 companies, and say, look, these are the 5 companies. Which is the highest risk? Which is the lowest risk? How much money would you be prepared to give them? And that's the level of understanding that we want you to get to. And that's knowledge that you'll be able to bring with you for the rest of your career. Okay, just 2 more things to show you. Number 1 is the workbook. So, and this is page 1 of your workbook. So when you go through the notes, you read through the notes, you'll get to a page and say, now we've explained all the concepts to you. You now should be able to do lesson 1 in your workbook, right? So, and I can't remember, I think it's about 15 or 20 lessons in the workbook or whatever. So Angelina will be sending you out your workbook. It's an Excel spreadsheet, and each workbook is a tab, you know, so there's only one sheet on each tab. So you just go across the tabs at the bottom. And looking now, so basically, if we know our liabilities, income, assets, and capital, can you look at that now and tell me what your expenses are? No, you can't, which is great, which is why you came to learn. Is that okay? So by the time you get to, now you have to wait until Monday week, unfortunately, now to get your risk notes. It'll be credit management next week. When you get the notes halfway through the week, you will be able to work out this, because part of working in credit, we're working with incomplete information. So even though they haven't told me what their expenses are, by the information I have got, I'm able to work out what their expenses are. And halfway through, not next week, the week after, you'll be able to do that too, simply by using what's called an accounting equation. So you know that these 2 numbers add up to these 2 numbers. You can work out the difference. Is that okay? So even though that might look daunting here at the moment, when you get to that stage, this will all make sense to you. Is that okay? So that's your workbook. You work through the workbook. And if you're stuck, talk to Angelina and say, look, I'm stuck on question 4. Now give it a go. Like, Angelina is not your first point of call, because it's better if you can work it out for yourself. Are you with me? And even on that, Angelina, and I'm saying it, I'm asking it too, that when you submit your short tests, Angelina will send you back the mark saying you got 7 out of 10. And she will say, you got 7 out of 10. The 3 to look at again are question 2, question 6, and question 9. Is that okay? Now, that's not us being lazy. What we then want you to do is go back to question 2, 6, and 9 and see where did you go wrong. Is that okay? And here is the thing. If you cannot see where you went wrong, that's when you need to shout to Angelina, say, Angelina, what on earth, what's this question 6? Because there's something that you missed or something that you don't understand. Are you with me? Whereas if we just send you the solutions, if I sat down here and did a trading profit and loss account, you would go, that's simple. It's when you sit down with a blank sheet of paper yourself, now it's not so simple. Is that okay? And when you get your results back for your short tests, you know, just have a look at question 4 again. Have a look at question 4. Go back and look at it and go, yeah, now I see. I forgot to carry the 1 or whatever, you know, or I added that and I should have subtracted it. That's stupid. Look, forget it. It's 0.02 of a mark in the overall. You know, there's no point in beating yourself up at that stage. It's all about a learning curve to understand. And if you don't understand and can't understand, and I just don't see where that number came from, then talk to Angelina and she'll send you the solutions and talk you through why we arrived at that and why we're doing that. And what I want you to do is I want you to understand the thinking behind it more than learning all the details off by heart. Is that okay? So that's kind of what your workbook is going to look like. And then your short test. This is the first 3 questions in your short test. So again, it's similar actually. Calculate the missing figure. So if that's your income, assets, capital, expenses, what are your liabilities? Oh, I love this. This is a really hard one. Extract from, so they're showing you from a trial balance. So that's your sales, that's your purchases, your opening stock, your closing stock. What is your gross profit and your margin? So again, applying the formulas to those figures to work out what is the profit on that. I don't expect you to even remotely know how to do it now. You'll be able to do it in 2 weeks' time. Is that right? So it is about learning. And sometimes you might have to read things 2 or 3 times for them to sink in. I think between doing the notes, working through the workbook in logical order, completing the short tests and submitting them, if you keep that going, it'll be fine. And if you don't, you know, and, you know, just keep going. So go through the workbook. Can't answer questions, go back. If you can't find the answers, email. You'll say, and then know the ones you got wrong, and then you go through, see if and if not, then we'll send you the answers and explanations. Told you earlier, revision session is scheduled 28th of October. I know it's the Saturday of the bank holiday weekend. If you can come, great. If you can't, we'll record it and we'll send you out the details and we'll just go through. So that's assignment 1 in terms of, we're not going to do it for you. You have to do it yourself. We will give you the pointers and adjustments and all the things that cause people difficulties as well. And I'm saying, relax, it will become clear. And, you know, even if, you know, you're daunted by the first set of notes, remember this, relax, it will become clear. We're here to help. And that's what it's all about. So I hope I haven't done anything to scare the life out of you now at this stage. I'm going to stop sharing so we can see you. And what I'm also going to do at this stage, is stop recording. Stop recording.